Let's go. Boom. Okay, let's do it. Boom. G'day, I'm Bryce Robertson, founder and CEO of Cultivate Collective, where we specialize in mobile home park investing, aka trailer parks. We specialize in really heavy value add. A lot of our properties that we buy are 50% occupied, and we have a really strong infill game, which I'll get into in a minute here. And today, I'm super excited to present to you our latest investment, a 500 space Tennessee portfolio, and I'll dig into the details. Quick disclaimer, I am not a CPA, financial advisor, or attorney. Do your own due diligence. This is for educational purposes only. So Cultivate Collective, we have 75 million of assets under management, which equates to 22 mobile home parks, mainly spread out across the Southeast, a little bit in the Midwest. We are heavily vertically integrated. We have our own property management company, asset management company, construction company, and in-house mobile home financing. And in an environment where interest rates have gone up faster than they have in modern history, and some operators have been holding back on distributions or doing capital calls, we're proud to say that we've been paying out our preferred returns to our investors like clockwork on all of our investments since 2015. And we have ultra recession resistant conservative underwriting, which I'm going to break into in a minute here. And I actually challenge you guys to go and find me someone who has as conservative underwriting as we do. And because of this, combined together, we have a 100% track record of exceeding our projections. We've been doing this since 2015. So why mobile home parks? Number one, they're really recession resistant. Number two, really low turnover. We have a 5 to 7% turnover in the mobile home park space each year, as opposed to 40% in multifamily apartments. We have some of the best tax advantages of any commercial real estate asset class. We are also the lowest defaulting loans in commercial real estate, and major supply and demand in favor of mobile home park owners. So there's 20 million Americans that are earning less than $20,000 a year right now. There is only 40,000 mobile home parks nationwide. Supply and demand is massively in our favor. At some of our parks, we have 85 people pre-screened, pre-qualified on the wait list waiting for the next home. And we get to help solve the affordable housing crisis, which I believe is a number one problem, real estate problem in America right now, and that's the need for affordable housing. My background is I got a 25-year background in construction and construction management, and I've been doing the mobile home park game full-time since 2015. So I'm going to show you guys a return structure that we've got here. We've got 4 different investment tiers: $50,000 investment, $500K, $1 million, $2 million. Something that I wanted to point out, the internal rate of return and the equity multiple. This is based off a 5-year investment, and I'll talk about the preferred returns and the equity splits a little later on in the presentation. So for our 50K investment, we're projecting a 16.66% IRR and a 1.95 equity multiple. All the way up to our 2 million, where we have an 18.44% IRR and a 2.09% equity multiple. Now that all sounds good, but what is behind these numbers? And that's what sets us apart from other people. Behind these numbers, we have ultra conservative underwriting, where we have built in the ability to have cap rates increase 2.7% between current market caps and 5-year exit. We can handle interest rates going up 3%. We can handle our construction timelines doubling. We can handle property taxes and insurance massively increasing. We can handle rent controls coming in every state in America, and all of that is built in behind these numbers. So we are really built out for a whole-out Armageddon-style economic downturn to happen, and for us to still hit our projections. And because of this, we have a 100% track record. Okay, so there's 2 things. There's the controllables and the uncontrollables. First, let's talk about the controllables and how we control those. That's implementing the business plan. We have our own in-house property management, asset management, construction, and mobile home financing. Nobody is going to manage our properties as well as we do. So we keep all of that in-house, and we have a really strong infill game. Most mobile home park operators remodel and fill 1 home per community per month. Our average is about 7 homes per community per month. We're really strong and quick at the infill game, and we have all of this in-house. And one of the things very unique about us, we have our own in-house mobile home financing, where we can provide financing to our tenants for our mobile homes. We can also provide financing to the actual communities themselves for the park-owned homes. That gives us a major ability to be able to scale very rapidly. Cool. So it's an 11-park portfolio consisting of 436 mobile home lots and 101 self-storage units. The properties are located in Tennessee and Kentucky. 9 of the properties are in Tennessee, 2 are in Kentucky, just across the border above Tennessee. We have most of them, the parks are in Nashville, Chattanooga, and Knoxville. And we already own 5 parks in the Knoxville market. We already have management team and efficiencies in there. We love working in Tennessee. There's no state tax. It's really easy to work with the cities and the counties. And with the great American migration and so many people moving to different areas, Tennessee's tons of people are moving to Tennessee. And so our test ads have gone through the roof. And we have a lot of demand in these markets. So we are actually going in buying this at $44,000 per pad. Right now, guys, we could resell this for $50,000 to $75,000 per pad, and that's not with doing anything. And we're at 25 to 30% under market rent. So we could raise rents, infill to 100%, and we'd sell well over $75,000 per lot. Over here on the offering summary, you'll see the purchase cap is 6.5. This market ranges between 5 to 6% on cap rates. So we've already got in 0.5% to 1.5% built in on the front end. And then our exit cap is 7.7%. That's either 1.7 or 2.7% increase between where we are in market right now and where we can project the exit we could handle in 5 years from now. Our expense ratio is 33%. Guys, we can manage these properties all day long for 20 to 25% operating expenses right now. So we've got a lot of build-in for supply chain issues, understaffing, and any of those complexities as well. We're stabilized at 82.8% occupancy. The purchase price is $20 million. It's a 5-year hold. And we're looking at about $12 million on the equity. And the basic infill plan is we've got about 20 vacant mobile homes. We're going to move our construction crews in, remodel those, lease them up, and then we'll fill the vacant lots with new and used homes. There's about 40 vacant lots in there right now. This is a really light lift for us compared to what we usually do. We usually fill in about 100 lots in each portfolio. In this one, we're only doing about 40. So this is a very light infill for us. That's where the parks are located, around Nashville, Chattanooga, and Knoxville, and a couple over the border in Kentucky. And again, we've already got 5 parks in the Knoxville area. Okay, this is what really sets us apart, controlling the uncontrollables. We cannot control the economy, interest rates, cap rates, supply chain issues, or any of that. So we build in tons in our underwriting to be able to handle all of that. So we can handle a 3% cap rate increase, a 3% interest rate increase. We can handle construction timelines doubling. We can handle property taxes going up 53% in year 1. We can handle insurance costs going up 26% in year 1. And so we're really, really built in. So would all those things actually happen throughout the hold period? Likely not. But if we think something could be probable in the next 5 years, we want to build it in to our investment so we have a measure against it. Because we want to be known as the group that helps people thrive through an economic storm, not just survive. Okay, so this is our 4 different investment class. You can see that we start off at a $50,000 tier with an 8% preferred return, 70-30 split. And then we trend up to 10% preferred return, an 85-15% split at the $2 million tier. So basically, more preferred terms for the larger check that our investors write. There's our underwriting again. This is our sources and uses. Basically, we bring in all of the capital that we need to do all of the construction and get everything up to 100% occupied, and we bring that up front so we can just hit the ground running, send our crews in, and really go for it. Right now, we actually underwrote with a 7.5% interest rate, even though our brokers quoted us 6.6 and 6.8. So we feel like we've got some wiggle room there. We're doing this with a 5-year CMBS debt. We have the ability to be able to potentially do a cash-out refi where we return maybe 25 to 50% of investor capital, but we're not that far in the deal yet. We just put this one under contract. So we feel like we'll end up locking in much better terms than what we've actually got right here, and we've underwritten with something even more conservative. Cool, and then here's our pro forma, and I'm gonna bust down to this slide here where you can scan that to get into our deal room. But basically, we're sharing our pro forma here as well. 10 minutes, boom. Well played.
Right, I'll get started. Great presentation. Really, I'm a big fan of mobile home parks. And so I guess just a couple, not really critiques. I think really for me, whenever you go into presentation, I would do a little bit of a dive on who you're kind of pitching to, not as far as like what their firm does, but their familiarity with mobile homes and the park, because I'm really familiar with the business, and I think that you base this presentation on educating somebody who probably doesn't know as much about the business. And for me, I want to know about the financing business because I know that's a huge part of kind of the marginal increase in value on these deals. I want to know the seasonality, of how, are these people coming and parking and staying, or are they coming in and out for different reasons, and really, I think the markets are super strong. And so for me, I guess I would, just because I'm very familiar with the business, my analyst is going to look at the numbers. Like, I don't care about the numbers. What I care about is the marginal increases in the bottom line that you can do, because being an operator, the financing business, the different, charges that you can do on the property, from the things that you can add on to these different parks once you get your hands on them. I know there's 1,000 ways to make money at these things, and you know that. And so I would focus on that. And then the financing too, for me, CMBS debt I know is very popular in the mobile home park business, but on the ability to exit and refi out of this, I think a lot of investors today, from deals that we're investing in, we invest in mobile home parks, so I definitely want to talk to you after on this. But they want to have a lot of flexibility, and CMBS debt hinders that flexibility because of the CLO market. So I think for me, really, my only critiques is kind of, know who you're presenting to. And I know this is kind of an interesting environment to do that in. But for me, I really would like to know kind of how you're going to push revenue, just kind of high level and not really see a lot of numbers. And also would really like to know and understand like the specifics on the true value add side. Going in and saying you can operate it better than everybody else and then you can change the numbers. I want to know like your top 3 things that you can do better than any other operator that I've seen do out there, and say that in 3 bullet points. And then after that, I'm going to pass all of this off to somebody else to check your numbers. And so really want to end with good presentation. And I'd like to talk to you after about the opportunity.
Beautiful. Thank you. Yeah. Hit me with the points.
Yeah, just on like your top 3 points on how you're different than any other mobile home, park operator out there, as far as this portfolio is different than just a run-of-the-mill deal out there.
Well, I don't know of any other mobile home park operator that has their own in-house mobile home financing, their own in-house construction crews, plus asset and property management. So I think that's something very unique about us. I do think the other thing is the speed that we can do the remodels on our vacant homes. We do about 7 per month. The average operator actually does 1 per month. Yeah.
And on the homes, are these manufactured homes that they're coming and dumping off, or are these plug-ins, or kind of, I guess that's what I was getting at, kind of the specifics of your parks and how,
So that's for the vacant lots. This property has 20 vacant homes or 18 vacant homes. So we'll remodel those, and it has 40 vacant lots. And we'll use a combination of new and used homes. We'll try and maximize how many new used homes we can use on the market. And then whatever we can't get in used homes, we'll get in new homes.
And do y'all have a wholesaler license to where y'all can buy those homes? Or
yeah, we've got a dealer's
You
license.
do? Okay,
yeah,
great.
We've got a dealer's license, and we've got our own in-house mobile home financing. So on the back end, we can provide financing to the tenants or to the park, and then we can make a net cash flow on the...
Yeah, so that's the kind of stuff that me is like a not sophisticated, but somebody who knows a decent amount about this space, like that's super attractive to me. Like somebody who has the wholesale license, can beat the market on the purchase, and then you can kind of finance on the finance as the people getting them in there. Because you talk about the average AMI of the people that are going into this, any type of financing help that you can help them get in the door, and then the ancillary kind of deposit income that you can get on that turnover is super helpful to the bottom line. And so that's kind of the little things that can make something that, to me, mobile home just goes to the mobile home, but you having those little ancillary things would make it more attractive to me. And so I would hit those harder if the person you're pitching to understands the business. But if this is their first mobile home park deal to look at, I think you nailed it from that perspective. But if it's somebody who knows a little bit more, I would hit harder on some of those real value adds that you have.
I appreciate that.
Great presentation, and I'm on the opposite end. I know very little about mobile homes, so
You were talking to me. One of the things that when you were talking, there was a lot of information. And I know you had 10 minutes, so it wasn't fair. A lot of information, really fast, and I saw from you all the upside. What's keeping you up at night on this?
Yeah, well, the things that keep me up is the economy, and it's the cap rates, the interest rates, the supply chain issues, the staffing shortages that happen internally with our teams, and also with third-party vendors and cities and counties, and delays in getting permits, and insurance is increasing, and property taxes increasing, and so all of those. So I can sleep at night. I built in
nothing.
I built in the underwriting. So that we could handle those things happening, because if we have a large economic downturn, and I study macroeconomics, and I think that's a probability, a decent probability in the next 5 years. So those are really the things, and then
When you say that in the numbers, you say it includes all the downside,
yes,
all the things you can't control. You put those to the downside for your numbers.
yes. So that was the numbers that you saw there were our worst case scenario recession resistant numbers. So meaning in our underwriting model for our exit cap, instead of having a 5% or 6%, which is current market, we've got a 7.7% exit cap in our underwriting assumptions. So our exit sales price is based off a 7.7 cap. And
One of the things when I on presentations with there's no problem, my ears go up. There's a problem. We all have problems. We all have issues and stuff like that. So from my perspective, since I don't know the market, so I'm coming from a novice in this side of it, but I love the presentation. I like what you're doing. I've got questions on, I want to look at the numbers and sit down. Things happen. And if you're saying I've got everything that's happening in the numbers,
yeah, come check it out, man. Come into our deal room, poke around in our underwriting model, and I mean,
that's what I got to do.
Yeah,
And I think to answer that question, I think it's the sector of the business is the risk. Because the mobile home park, it's very hot right now, but it could be the Shallow Bay Industrial of 12 months ago that was trading at 9 caps 2 years ago, and now is at a 5 cap and could trade at 10 caps again. So I think his underwriting is probably right. I think the biggest issue for me on this product is if in 36 months there's a Wall Street Journal article just being like, this is now out of favor, and then there being no buyers. And at the end of the day, you'll have a bunch of cash flowing deals on a large piece of land. So in theory, there's something left there. But I think that's likely the biggest risk from my perspective, just with this sector as a whole, is the market favorability and institutions staying in this space. And that's just my take on it.
Thank you.
thank you.
My question is, which accent do you normally use depending on what group you're presenting to?
I just go with the flow.
Yeah, I know you do, man. No, I appreciate it, Bryce. I've known Bryce for a while too. And so what I would say is, I love the way that you executed and you showed the numbers directly of what you're going to do, and you're showing it from the downside perspective. But kind of along the lines of some of the questioning you guys had too as well was, from a downside perspective, what happens if you got to hold them longer? And on the financing realm, in-house financing realm, that would be something I would actually probably push to the forefront, because the amount of profitability in that type of business could actually far exceed, some of the assets themselves. And so, if the hold could extend for that, what does that look like for the equity and the capital you're putting in? Because you're raising 60% of the purchase price, right?
Yeah, and that's because we're doing a lot of capital expenditures.
And so that would be the other thing I would hit on, because you said, all right, we had the 18 that we're going to go in there and rehab, and then we have 40 empty lots right now, and having the understanding of how you're about to spend, a good chunk of the money that you're raising on the capital improvements to achieve, I think it said 25 or 30% rental income increases that you showed. That would need to be justified, right? Because obviously it's a big number, but that would be kind of where I would try to answer those kinds of questions, because that's the big jump. Hey, we're going 25, 30% higher rental income, but you have to have some of the qualifiers behind that of what we're doing to be able to achieve that, to make that reality.
When you were talking about the financing, do you have a separate LLC that does all the financing?
We have our own mobile home transformation fund that provides the financing for the mobile homes. but we don't provide financing for the actual communities themselves.
Right. So any revenue, any income you make off the financing would not be part of this deal. That's all outside.
There is a lot of profitability that happens consequently because of it. That happens for the mobile home park level. So it's a win-win-win scenario. The tenants get true affordable housing loans, like legit affordable housing loans that they can qualify for, which is a real challenge with mobile home tenants. It's also very profitable for our parks and our investors, and it's also very profitable for our investors in our transformation
I
fund.
think it's because I don't understand this. Is there a line item on the income statement for financing income for this property?
For financing income, no, there is not. No.
And yeah, last one. I would really sell the downside kind of stability, because like the thing that I love about mobile home parks is that it's on a ton of land, and in these markets, like they're growing to where you are. And so again, to the downside scenario, I don't know how many acres these things are on. You know, you could probably put up, we're buying it for X. Here's what the land value is today, and we've got cash flow. Yeah, and so if you have to hold it for 10, 15, 20 years, I mean, sure, it's probably not going to be a great IRR, but, you know, if we're looking at something and I get stuck in these deals for 10 or 15 years, but we're on 30 acres in growing markets in Tennessee, like very low likelihood I'm going to lose all my money, as opposed to trying to do a 1970s deal in College Park in Atlanta and buying it on a 3 cap, you know? And so I just think that like one thing that you could sell that you really didn't is the downside worst case scenario. We have to stay in these deals for 10 years. You're going to make a 6. If we sell the land for what we bought this deal for today in 10 years based on, you know, this growth average. I just think that this asset class I love because you're getting a ton of land and cash flow on top of it. And so at the end of the day, you have something very tangible that you can sell, and if financed appropriately, it has some underlying value.
Thank you.
Questions from the audience?
Yes.
You said loans for the tenants.
Yes.
Why? What are you loaning to the tenants? I thought they were rentals.
No, so if they want to own their mobile home, so we rent the land to all of our tenants. And then if the tenants want to actually buy a mobile home office, because we brought in a new or used mobile home, they could either rent it off us, or they could actually buy the home and pay the financing. And so in that case, they would pay the lot rent to the mobile home community. They would pay the home payment to the transformation fund.
Or they could just rent it all from you.
Or they could rent it all from me. And we can, in that case, we can provide financing to the mobile home park. And then the mobile home park collects lot rent and home rent from the tenant and make about a $200 per month per lot delta on the $450 home payment.
And
So-
then when they want to leave, do they take their home with them?
So no, the mobile homes don't technically leave. So they're very, very sticky. So here's the thing, to move a mobile home and move it into a different community or a different place, it's gonna cost about 10 grand. And so these guys are in affordable housing, they don't have enough money to move their home. So if they're going to move home, they're just gonna move out of that home, sell it, and then buy another home at a different community. It's actually cheaper for them to do that. So we have the homes stay in our community.
So just tell me, I still don't get it, why it's better for them to rent it or get the loan.
Well, it depends on if they want to be a homeowner or not, because if they rent it, they're going to be paying rent forever. If they get the loan, they're going to eventually pay off the home, and then they own it.
How long is usually the loan to pay it off or to buy it?
We amortize the loans over, I believe it's 10 years. Yeah. And then when we sell the community at the 5-year exit, we actually have the buyer of the community actually pays off those loans and kind of takes it over, so we can pay off the transformation fund, replenish the mobile home community, and then they're responsible to be able to figure out their own financing there forward. Yes.
I'm also not a citizen, don't know about home. What do you do about security and HOAs and insurance?
Yeah, so I mean, insurance is basically, a lot of it's governed by the lenders. Our lenders want to have a certain quality of insurance, so usually our insurance is equal to what the lenders are looking for. We don't have a HOA per se, but we do have community rules. There's 3 main rules: no pay, no stay, be nice to your neighbors, and keep your yard clean. and we have compliance. The no pay, no stay is really easy. To evict people in the mobile home park space for non-payment of rent happens in about 3 weeks to 3 months, depending on what state you're in. It's very easy, and when we evict them, we actually get their home back as well. So it's very easy to evict people in the mobile home park space if they do not pay their lot rent. Cleaning of the lot, if they don't keep their lot clean or the outside of their home clean, we send them a notice to cure that. And they've got a certain time period to cure it, and if they don't, we go in there and we cure it for them, and then we bill them back for it. And then just being nice to your neighbors is we just uphold that in our communities. Yeah, and so a lot of that is actually selecting the right tenants. So when we buy a mobile home community, we might have to kind of phase out a couple of bad eggs. And then when we're bringing in new tenants, that we're screening them, we're finding people that we really want in our communities. Yes.
Do you keep all these loans on your balance sheet? Do you see a lot of default where you have to take them back?
No. No. Yeah. Yes.
Two things. So first is probably comps, like how popular are these assets? What are your, kind of like other competitors you can look at to validate your number? And second is for mobile home park, what is really, I know you mentioned your numbers cover a lot of like situations, but what are the break-even point? At what point does occupancy drop to what level, or increase to what level, or the expense increase to what level? Like, can you share more specifics on that?
Yeah, totally. So the first question is, in Tennessee, we're ranging between about 60 to 75K per lot. That's what mobile home parks are trading for right now, about 60,000 to 75,000 per lot.
And what about rents? What about
Rents, about 450, which if you're with a park-owned home, it's double, so it's 900. So yeah, we're about at 900, 950 in those markets. Yeah, and our rents at this community are like 318. Some of them are. So yeah, and then the second question was the downside protection on the break even. Operating a portfolio of this size, our track record says that we would be about 20 to 25% operating expenses. So, and then we've got the debt service on top of that. So, I mean, we'd be looking at probably like 35% or something like that of revenue.
what about occupancy?
Well, that's 35% occupancy, yeah, yeah.
Same final question.
So is there ever, I know you said there's no defaults, but what happens if someone's not paying? You finance that home, but
Yeah.
also you've got investors in the deal too. So you've got an eviction and a foreclosure at the same time. The eviction probably happens quicker.
Yeah.
You're incentivized not to evict because then you'd get wiped out and lose all the money you financed for the deal. How does that kind of conflict work itself out?
Yeah, well, it really goes in alignment with eviction, and that's the powerful thing about mobile homes. So, yeah, we evict, we get the home back, and then it's very easy to foreclose once you've had the eviction. Yeah.
Thank you.
Cool. Thank you.